Welcome to the 2024 September edition of the ithought Fixed Income Outlook. This month our focus is on bonds. My colleague Vinayak and I did a comprehensive webinar on everything that you need to know about bonds. So if you haven't watched it, you can click on the link in the description below. But let's take a quick look at what has happened in the bond market and why so many investors are actually keen on investing in bonds. So if we look at the major regulatory changes that have supported this change in investor preferences, we notice that there are a few important milestones that we've crossed. The first is that the RBI introduced a platform known as RBI Direct, where retail investors could directly participate in the government securities market. So this enabled investors to start investing in safer bond investments on their own without a broker dealer. The second big change is that SEBI has been pushing for the minimum face value of bonds to come down. So a few years ago it used to be at 10 lakhs, then it came down to 1 lakh and now it's at 10,000 rupees. This ensures that investors with a smaller sum of capital can also participate in the bond market. The third big change has been on the taxation front, where previously there was a difference between how mutual funds and bonds were taxed. So investors had the benefit of indexation if they chose to be longer term investors in fixed income assets like mutual funds. However, with the change in taxation and the removal of indexation benefit, the playing field has actually been leveled between bonds as well as mutual funds. So many investors in the higher tax bracket have actually been looking to maintain their post-tax returns and have turned to bonds as a solution. So all of these have actually driven more investors into the bond market over the last couple of years. And it's important for these investors to understand how this bond market actually works. When we think about the structure of the bond market, it's very different from the equity market. Even if bonds are listed, they don't trade as frequently or in as many volumes as stocks do. This is because largely the market is broker driven, which means that investors do need to go through an intermediary to participate in the bond market. And typically the players in the bond market are institutional investors, so the ticket sizes are much larger. So for a retail investor, bonds are still very much a source of income and a hold to maturity kind of investment. One important thing that every investor should know before they make a bond investment is that each bond is actually unique. So the same company can issue many different types of bonds, and each of these bonds could actually have a different credit rating, because each bond issue may have certain unique characteristics. So some bonds may be secured, which would give them a higher credit rating. Some bonds may have a put or a call option, which could again have an impact of bearing on the credit rating and the level of risk in the bond. Or you may have some debt which is considered to be senior or priority in the order of bankruptcy or liquidation. So with all of these different features and characteristics, no two bonds are actually alike, even if they are issued by the same investor, even if they are issued by the same company. Bonds are a very interesting asset and can have an important role to play in your asset allocation. Do consult your investment advisor before you make an investment in any fixed income instruments.